No matter your age, your plan for retirement can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. You know, I've been watching, well, we all have, right? There's a lot in the news. Of course, the horrors that are going on over in Ukraine with Russia's invasion, and in the effects that's having as far as oil prices. And of course, oil prices were already going up. We've already had inflation in place. To get to understand, for instance, when we're talking about year-to-year, year-over-year inflation, what prices were a year ago to what they are today, and you're looking at an increase of almost 8%, understanding that's the average over the 12 months. And what that means is that things are kind of accelerating. So if we look at, go back a year ago, and we look at that first 6 months, the inflation rate was lower during that period. It's higher now. And if we're averaging that at 7.9, it actually means right now we're probably experiencing something more like 10%. And keeping in mind, there was a recent report, how they've changed how they track inflation. In other words, how they track CPI, the Consumer Price Index. And if you look at the way it was done back in the 70s and 80s, if at that time we had double-digit inflation. Well, if we were still doing the same accounting or of how we came up with the inflation number, we would be at about 16% right now, okay, based on that. So just to, again, put in perspective, it is like 45 years ago as far as what we're experiencing. And then what does that mean going forward? You know, what does that look like for you as far as your, but one, for planning, but also understanding when you're hearing these numbers, and you got oil prices going way up, and you've got inflation as high as it is, and now you're talking, of course, the Fed's going to be raising interest rates next week. What's that going to look like in terms of the economy, how it could affect things when people start talking about the likelihood of recession going way up? These are all concerns in terms of the markets, in terms of the economy, of course, how the effect it can have on jobs. So there are a number of negatives that go into that. One of the things you want to be thinking of is for your planning is how to, you know, when it comes to recessionary times or that potential, not a bad idea to do these things anyway. But there's some tips, excuse me, on how you can weather these type of times. One of them, pay down any debt you have. Really get focused on thinking of, boy, if things did go this way, what would I want to do? Well, you'd want to get rid of that debt. Get more aggressive with that. Watch your discretionary spending. If you've got some big purchases that you've been considering, maybe a big remodel, renovation, maybe, you know, buying a new car, making sure that that's going to fit in the budget and downturns are not going to impact you. This is where cutting back a little bit there might be wise. Boost your emergency fund. This one, again, make sure you got a little extra cash on hand to help you if things get a little tight. Focus on the long term. This is one of the big ones. You know, it's not about getting things right every time. It's about getting it right over the long term. This is the most important piece, is that we're just like with investing, your long-term investors. So if things, you know, check your risk tolerance, check in, you know, your asset allocation models, make sure that you're properly positioned and that you're not, you know, again, it's a good time to just reassess your risk, if you will. So, and there's another one. Taxes. This is that time of year. So when it comes to taxes, one way that you can also help yourself in a time when we may be going into, you know, some tightening and potentially even a recession, is think in terms of what you can do to, again, minimize costs. Well, keeping your taxes down is one way to do that. Not paying more in tax than you're legally required to pay would be one way to start. And that seems like such a no-brainer, right? But it's amazing how many people pay more than they're legally required to pay simply because they don't understand the rules. Well, we're going to be talking about today, we've got a great program through Nationwide Retirement Institute, managing the taxes on your retirement income. This is going to apply, of course, most importantly, retirement, in particular when you're in a fixed income. Watching your expenses and taxes being a big one is a great way to do that. And here helping me to go over this today is Dr. Friday. with Dr. Friday's tax and financial firm over in Brentwood, Tennessee. She is the tax expert for individuals and small business owners. All right, so you're staying pretty busy?
Yeah, it is a busy time of the year.
Yeah.
Everyone, at this point, everyone's just tracking what happened last year, and I think that this show is really great because we also need to be thinking about what we need to be doing in 2022. We all get so focused in tunnel vision when it comes to preparing, at least my world is always very tunnel vision for the first quarter or so of every year. But with all these changes happening, I mean, seriously, 2 weeks ago I filled up my truck and I have diesel. It was $4.40. Yesterday, I filled up my truck. It was $5.45 per gallon. I mean, that is over 2 weeks. I mean, with those kinds of changes, like you just said, it was a great opening. We need to reevaluate, some of the things that we might have some control over. We can't control petrol prices no matter what we do, but we may be able to control eating out. My one brother works in the restaurant industry. They've done an 11% increase across the board on all of their costs. It trickles down. Everyone has to still make enough profit to survive, right?
Yeah.
I mean, and that's like the stock market. I mean, that's businesses doing what they need to do and how they're going to do it. So hopefully today this show will help give people an idea of maybe some steps they need to be taking or looking at, other than just, I'm not going to get my car, I'm not going to do this, I'm not, I mean, you got to still live your life.
Well, and this is, when you're in retirement in particular, you're thinking of the wages have gone away, right? But you're now supplementing your income typically with money from your retirement accounts. Right. And that money is, as far as the IRS is concerned, that's income. It's still taxable. You don't have the payroll taxes to pay on it, but you certainly have federal income tax. And then depending on how much you're taking out of those, it could have an impact on your Social Security benefits, whether they're taxed or not, or how much they might be taxed. Medicare premiums, you might be paying more there. So understanding the best way, developing, if you will, a a tax-efficient retirement income plan is really critical as you're, going into retirement. And we're looking at ways that we can reduce taxes, again, over the long term. The short term, you're not always going to
be tax-free.
One of the things with asset allocation with anything, you think in terms of how you're invested is another one that plays into it. So it's not just about every time I've got to do this just right. It's more about over the long term making sure you have a plan. So an example would be when it comes to taxes, sometimes maybe paying a little more in tax one year could save you down the road. And that's where we get into Roth conversions as an example of that. Right. So let's take a look at our first slide. On today's agenda, we're going to go over the tax basics. So the first thing is just kind of go over the tax code, give you an idea as far as what the different tax brackets are, how the tax code works, the difference between ordinary income tax and capital gains rates, the importance of diverse retirement income sources. This is a key one. In particular, the more in advance of retirement that you have, be thinking in terms of maybe I want money into an IRA or 401k as an example, maybe Roth, maybe I'm contributing to a Roth at the same time. If you've got a Roth 401k option, that could be a real attractive. And then sometimes it's just saving. It's also building up outside of your retirement accounts, saving up money in what we would call a non-qualified account. And this can also help you. The more diversified your income sources are, right? And that means, again, Roth, traditional, and non-qualified, right, the more flexibility we have in minimizing taxes on your income. So there are two kinds of taxes on income. We'll get that next slide up, on ordinary income and capital gains. And Friday, I'll let you talk a little bit about that.
Let me talk about that. All right. So ordinary, most people understand that one, right? That's when we have your wages, ordinary capital gains, which is obviously wages, certain retirement accounts, bank accounts, Social Security income, all of those can be, and also short-term capital gains, all fall under what we consider ordinary income tax. Then the one that's really attractive, the one that we try to get more into, is the capital gains rates, because unless you're in the 12%, which is really cool, because if you have your capital gains and you have long-term and you're in that 12, what we used to call 15% tax bracket, capital gains could be 0. And I think sometimes people don't maximize that. They don't realize that if you're doing some changes or doing some maneuvering, sometimes you can do it. If you do it in smaller bites, you might be able to do that in the point of being able to do it at 0 rate. Had one the other day come in and they were just so surprised that they could actually hit that 0% rate. But capital gains then goes up to 15, 18.8, 23.8. That way you have all of the different rates. And it's usually still much more attractive than ordinary income rates. So we tried to do more in the capital gains. But, you know, sometimes paying that ordinary income rate is still better than waiting until, I mean, I think what one thing Hank always does, a lot of my clients or individuals, I think was really great. He actually gives you this big picture, because sometimes you're thinking, I'm just going to wait, I'm going to wait, I'm going to wait. But sometimes that waiting could cost them a lot more in tax dollars than if they just make those steps in the right direction. You know what I'm saying?
Capital gains rates are always going to be lower, as Friday's just saying, than ordinary income tax rates. So this is one that you want to, in understanding that, and then how you invest and how you, make same thing. It's not just from your investments, but also from selling real estate.
Right.
So again, this isn't meant to give you, professional investment advice or tax advice, right?
Not a good idea.
Again, we're going to deal in generalities for you. You need to talk to your financial advisor, talk to your tax advisor, the person that helps you with those things, and go over your specific situation with them. All right, we're going to take a break. When we come back, we're going to delve into this in more detail. But first, a break. Join us here. We'll be right back on the Retirement Report.
This is a story.